If you want to become an intelligent investor, then you've landed just at the right channel. With this, let's start the video.
So I have, put some snapshots of certain corrections, so let's go through these corrections one by one. So the first one is obviously this correction from the year 2000 to 2003. It was one of the, biggest corrections that India has seen. As you can see, the markets fell. So this is a chart of the CNX 500. So I have taken CNX 500 because it represents a broader market versus a Nifty or a Sensex, which just represents the large cap. So CNX 500, the data was available in TradingView from 2000. So 2000 to 2003 was one of the big corrections. The markets fell about 61 points percentage from the top, and the correction lasted almost 3 years. Right, so it was a deep and a long correction. The next big correction that the Indian markets saw was the 2007 to 2009 correction. This was the big, the subprime crisis correction that the Indian markets saw. In this correction, the markets corrected 67% from the top, very similar to what happened, post the dot-com bust. But this was relatively shorter than the earlier correction, whereby it lasted, about 1.5, 2 years, right? But the depth of the correction was quite brutal here with 67%. Post these two large corrections, India has not really seen a very deep correction. So I'll come to, so COVID, was one correction where there was a pretty sharp fall, but it got corrected very quickly. It got corrected within a couple of months, right? So I won't categorize, that in this discussion today with respect to these snapshots. So all the other corrections that India has seen are magnitude corrections, which means that they have been long corrections, but not necessarily very deep. And the reason for this has been post 2007, the Federal Reserve, discovered this whole idea of quantitative easing. And since then, not only in India, but even in the US, we have not seen a deep correction. We've seen periods of, long sideways movement. And that is how the market chooses to punish us now. Because the moment there is a deep correction, the Fed comes into play and stabilizes the market by printing money. So that has been the story post 2007. So if you see the data before 2007, if you see the US market history, you will see a lot of deep corrections like that. 1987 in the US, even earlier, there were several corrections like that. But post 2007, the depth of the correction has gone away to a large extent. And now what we get are long corrections, of sideways markets or consolidations. So if you see this other correction from 2010 or 2011 to 2014, another 3 years where the market went nowhere. Another correction from March 15 to Feb 17, another 2 years where the market went nowhere. And then the September 18 to just before COVID, market went nowhere for about 1.5 years. So all of these were mostly sideways markets, which lasted for anywhere between 1 to 3 years. And finally, more recent data, the last sideways movement we saw was post that COVID rally we saw from October 21 to July 23, almost 2 years, the market went nowhere, right? And then the one that we are in right now, whereby the market has not gone anywhere for the last 1 year. The correction started in September last year, and we are in September 25 now. So we have to see how long this one lasts. But suffice to say that we are definitely in a sideways corrective market right now. So these are all the different corrective phases over the last 25 years. Of course, there have been other smaller corrective phases, so I have not been able to cover all of them. But I think this gives a good, big picture understanding of, what these corrections look like. So having seen, all of these examples, let's look at what patterns emerge from this, right? So what are the different commonalities that we see in these different corrections? So like I, briefly mentioned, there are two types of correction. One is a correction of magnitude and one is a correction of duration, right? So magnitude correction is a deep correction where the stock price just crashes very sharply. And a duration correction is a long period of sideways markets where investors don't make any money. So both of these corrections are pretty brutal in their own way. And very rarely you get both. Like I gave you the example of 2000 to 2003, and even to some extent 2007 to 2009-10, right? You got corrections which had both magnitude and duration. But fortunately now post the Fed era, most of the corrections are duration corrections, which means that the corrections which are lasting for a long time. So that's one thing to understand whenever you're looking at a correction, whether it's a magnitude correction or a duration correction, or is it both. The next pattern that emerges from all of these examples is that a correction is always preceded by a period of high returns or a period of bull markets. So I would go on to say that it's almost a requirement. It's a prerequisite that before you have a major correction, you should have a period where the market has rewarded you. So the market is a very fair animal, right? It rewards you and then it punishes you, right? Without a reward, very rarely will you be punished very drastically. So one of the major patterns, if you go back to those charts and see, right, all of those sideways movements were preceded by a very, very sharp rally before that, or a rewarding period before that. If you see this period here, there was a sharp rally here. If you see this period here, there was a sharp rally here, right? If you see this, obviously so there was a sharp rally here. If you go back 2007, I don't have to tell you, right? 2003 to 2007 was one of India's biggest bull markets, right? And post that big bull market, you saw, that 2007 correction, and even the dot-com, right? Before this crash happened, there was a big bull market in technology and dot-com stocks. So one of the prerequisites of a correction is a bull market preceding that. So a lot of people give an example of Japan, right? Whereby they say that Japanese market has not gone anywhere for the last 20 years. But what people don't realize is that go back and check what happened before that phase started. Japan probably had one of the biggest bull market any country in the world has seen, a biggest and a longest bull market. So because there was so much money that was made in Japan before that, it went into this period of sideways for multiple decades. So anytime you worry about a correction, you have to first ask, have we gone a period of very good markets before that? If that is the case, then the correction is likely to happen. Similarly, the other side of it is that the correction is what sets the stage for the next bull market. So every period of correction, right, whether it was 2009, whether it was 2013, whether it was post-COVID, and whether it was, after the recent 2021-22, bearish phase, the correction sets the stage for the next cycle. So it's a continuous yin and yang sort of combination of bull markets and corrections, right? It is the rhythm in which the market moves. So you have to keep this pattern in mind. And finally, the other pattern that comes out of this analysis is that the sharper the correction, the quicker is the bounce back. And we've seen that in COVID, right? The quicker the market falls and the deeper it falls, it is like a rubber band, right? So the more you pull it, it'll snap back, with a similar ferocity. And the longer the correction, the longer the next bull market. So like I said, the biggest bull market India saw was from 2003 to 2007. But before that, the period of 2000 to 2003 was a hellish period. So if you speak to any investors who have been around in that period, nobody was interested in the market. It was a very long 3-4 year correction. And it was also a correction which was deep and long. So it was a very painful correction. And that painful correction gave birth to the one of the biggest bull market that India saw in the next 4 years. So the longer the correction, the longer the bull market, the sharper the correction, the quicker is going to be the bounce back. So these are some of the patterns that we can take away from our analysis of the last few corrections that India has seen.
So if you loved this video and you had a differentiated business insight, then do subscribe to this channel, and you can also follow our main channel of SOIC. Thank you so much for watching it.